AG Infra and Engineering posted a strong set of results for December 21 quarter, supported by robust project execution and improvement in margins thanks to benefits of operating leverage. The government's focus on infrastructure development remains strong, with increased allocation in the recent union budget as well as the huge investments planned for the national infrastructure pipeline. This will keep infra spends elevated. The current inflationary scenario will have a relatively lower impact on the infra segment, as most contracts have a raw material escalation or pass-through clause. AG reported a margin improvement in Q3 FY22 despite higher raw material prices. AG's diversification into newer segments would reduce concentration risk and enable re-rating. The company has a track record on timely project completion and maintenance of financial discipline, with the debt-to-equity ratio which has remained below 1x. And AG is among our top conviction picks in the infrastructure space. The stock has fallen at a higher rate of 12% in the past 3 months compared to Nifty's marginal drop of 3% in the same period. The stock is trading as attractive valuations, and we advise investors to add this stock to the portfolio. AG's revenues grew 27% year-on-year in Q3 FY22, led by strong project execution. It maintained gross margins on a YOY basis as the increase in raw material prices was offset by lower outsourcing as well as site expenses. Operating leverage benefits on account of a strong top-line growth saw operating margins improve by 120 basis points on a year-on-year basis. AG's net profit, meanwhile, saw a strong 48% growth. AG Infra received strong order inflows worth 4,326 crores in 9 months of FY22. It has already bid for projects worth 26,000 crores and expects to win some orders in Q4 FY22. Overall, AG expects to close FY22 with order inflows worth 5,000 to 6,000 crores. AG's total order book stands at 8,794 crores, including recently won projects, which is about 2.4 times its FY23 projected revenues, providing healthy medium-term visibility. With robust order inflows and strong order book, AG expects a healthy top-line growth of about 15 to 20% over the next 2-3 years. Its current order book is entirely from the road segment, and the company is aiming to diversify into new areas to reduce the concentration risk. The company is targeting railway projects, airport runways as well as water projects under the Jal Jeevan mission. Management says the nature and qualification criteria for the railway and airport projects are similar to roads, and as such, AG can tap these opportunities. For water projects, the company has tied up with other external players. AG Infra was expecting some order inflow in the current fiscal year as well. However, project ordering under railways and water segment got delayed. AG expects order inflows in the non-road segment in FY23 to start trickling in. Overall, it's targeting about 20% of the order book from the non-road segment over the next 3 years. Prices of raw materials such as cement, steel and diesel increased steeply from H2 of FY22 onward. AG's margins in Q3 were affected by about 40 to 50 basis points owing to the increase in raw material prices. Raw material prices have inched up further from the end of Feb 22, which would affect margins in the near term. However, management has stated that most contracts have the raw material pass-through clause. While margins may be affected in the short run owing to sudden steep increase in raw material prices, we expect AG to largely recover the cost increases over the life of the project. Recently, the government placed restrictions on bidding for road hybrid annuity model projects constituting about 55% of order book of AG, and now there will be a criteria for bidding capacity as well. A lot of new and smaller players that have won projects in the recent past will have lower bidding capacity and therefore will not be able to bid for newer projects. Competitive intensity is expected to reduce, and this would benefit incumbent players such as AG Infra. National highway construction and awarding activities largely kept pace with last year up to H1 of FY22. However, H2 of FY22 saw a slowdown in both construction as well as awarding of activities. We expect strong pickup in both execution as well as awarding activity in FY23. Highway road development continues to remain a key priority. The government has increased allocation to the road sector by about 70% in the FY23 budget. The government has targeted highway construction of 25,000 kilometers in FY23, which is almost double the record levels witnessed in FY21. We expect a strong pickup in the next fiscal, which is positive for players like AG Infra. At the current market price, the stock is trading about 9 times its FY23 projected earnings, which is at the lower end of the historical long-term average, and hence we recommend investors to add the stock to their portfolio.